is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Re-rating rate bets. Global stocks struggle for direction as surprisingly strong U.S. services data fuel concern that the Fed will need to tighten more than expected. Not done yet. The Reserve Bank of Australia raises its benchmark for an eighth consecutive month and warns there's more to come. The Aussie dollar climbs. Plus, the U.S. and the EU are said to be weighing joint tariffs on Chinese steel and aluminium to fight emissions and global overcapacity. So first thing is first, let's check in on the markets. Even U.S. futures for the moment are struggling for direction. Now, it's very clear that we saw a resilient U.S. economy. That's on the back of services data yesterday. Also, sticking inflation really countering some of the optimism that we saw about reopening in China. Money market futures economists also suggesting that the Fed will actually need to push rates to higher peak than previously suggested. So this is a picture across the board for European stocks. I don't know whether we have a map to see whether there's a huge difference between Germany, France, Italy, and elsewhere. You can see it's pretty much flat, just a little bit of gains for the DAX. But again, they're tiny gains, I think, as the market is trying to figure out what happens next, and so struggling for direction. So unexpectedly strong U.S. services data, adding fuel to traders' bets on how high the Fed rates hike will go. Now let's get straight to Alex Brazier. He is deputy head of the BlackRock Investment Institute. Also, for as many years, the Bank of England understands not only financial stability, but also what it takes to deal with inflation. Alex, thank you so much for joining us. We're at this pivot point. I don't know how you would describe it, whether it's crossroads, but the market is still grappling with the fact that even if we see peak inflation, then interest rates have to go up. Like, what's your terminal rate for Fed, but also here in Europe, ECB?
Yeah, I think, take a step back. I mean, we need to rethink what central banks are about now.
Yes.
For the past 30 years, they've been the cavalry that's come to the rescue when growth has slowed. But right now, they're actually needing to create economic damage to get inflation all the way down again. And that's why you won't see rates stop rising just because we see weak growth, and you'll see rates stay higher for longer as central banks really try and drive economies into very weak growth and inflation in order to make sure inflation comes all the way down or close to all the way down to their targets.
So how much pain will that inflict, I guess, on markets? The bond markets are seeing one thing, equities believe in something else.
Yeah, and I think, well, bond markets believe in rates reaching a terminal point and then coming back down again. Actually, that's a bit of the old playbook as well. In all likelihood, rates are going to go to 5, possibly north of 5 in the US. They're going to go to 2 3/4, possibly 3 in the Eurozone. But importantly, they will then stay there as growth weakens, as those economies enter recession, because that's deliberately what the central banks are trying to create. They're trying to damage economies because they're effectively overheating. Even though the level of activity isn't back to its pre-COVID trend, we're seeing core inflation pressures because of all these supply-side constraints in labour supply, in energy supply, all of which mean economies can't operate at the level they were used to.
But so, Alex, are we underestimating then the timeline of how long it takes to unwind this great experiment?
No, I don't think so. I think the thing markets are underestimating is how far rates need to go and how long they need to stay there in order for central banks to deliver their objective. And
so, it's a terminal rate for the Fed is around what?
5, possibly a bit higher. For the ECB, 2 3/4, possibly a little higher. I think the difference is explained by a different level of neutral rates in those economies. But they're both effectively trying to do the same thing, which is take rates to restrictive territory and keep them there in order to generate effectively a recession, if not very, very weak growth for a sustained period. I
mean, one of the most heated debates I've had on neutral rates with Eric Nielsen, so massive shout out to Eric to always trying to take the counter argument on anything that has to do with neutral rates. Alex, when you look at where we need to be, how much pain are we going to see in markets? And are we going to be in the stop-start equity market until we get to grips with, the reality that you're explaining?
Yeah, in all likelihood, yes. And that's why we published our outlook last week. It's why we're not yet ready to be positive on developed market equities. But there will come a time next year, in all likelihood, where the degree of damage central banks are looking to create, we get clarity about that, and it's reflected in the price. At that point, we see big opportunities in developed market equities. So we're laying out not just a sort of fixed asset allocation for the year, but actually a sort of playbook for the year that says, if this, then this.
Yeah, and I know it's proprietary, so we won't publish it. But actually, it's a beautiful outlook because it's very easily laid out and easy to read. When you look at what this means for a global or U.S. recession first, I mean, the Fed will probably want some kind of recession. So is it a misnomer talking about whether we can avoid one?
I think so. I mean, Powell talks about engineering a period of basically no growth for a sustained period. Now, it's very difficult to engineer that without some fall in output. But when you look at the numbers, we think, given the labour supply constraints, particularly in the US, the Fed would need to engineer a fall in output of around about 2% over the course of the next year if it's going to get inflation down as quickly as possible. Now, in all likelihood, it's not going to go quite that far. But this goes to the point that it is deliberately creating economic damage and has acknowledged that now in order to try and get inflation as far down as it can on a reasonable time frame.
Alex, I know we'll talk a lot more about China shortly, but actually, how should we view China? I mean, this could be a huge game changer. If they really open up in March, April, what does it mean for energy prices? What does it mean for world productivity?
Yeah, I think there are two things going on in China. One, of course, is the reopening, which will be bumpy because even though the policy is lifted, the public health situation means that there will still be lockdowns. We'd probably see very weak growth in Q4, for example, as a result of this. But don't forget, China needs a big boost to domestic demand to combat what's happening to export demand. It was a huge beneficiary in the pandemic from the fact that we were all buying goods and not going out and consuming services. That's now turning around. And what was a 2-point boost to annual GDP growth in China is going to shift to being a 1 to 2 point drag on GDP. That's such a big turnaround that China really needs domestic demand to restart very rapidly if it's going to avoid a very severe slowing in overall aggregate demand.
Yeah, so I'll ask you what this means for regulation in a second. But when you look at financial stability, and this goes to their leverage. So if you go from 1%, 2% interest rates to 5% in a short period of time, where do you see the main fault lines? I know we're talking about, probably currency derivatives. There's pockets of the markets outside banks. How much of a concern are they to you?
Not a great concern, but there's always some risk that sharp moves in asset prices, particularly yields, as you highlight, expose something. We had the episode months ago in the UK, for example. Now, it's likely that when rates move this sharply, you'll see pockets like that. But I think this is a very different situation to the one in, say, 2008, where sharp moves in asset prices created a systemic problem. We will see pockets, but not a systemic issue.
So, no, I mean, do you worry about shadow banking? Should that be more at the forefront? Zombie companies, shadow banking, a kind of...
No, I don't think so. And I think shadow banking is a bit of a misnomer as well. There are certainly things like shadow banks that are doing things that are banking-like. But sometimes people have a tendency to lump together the entire non-bank system. There are pockets of shadow banking, but I think they are reasonably small.
All right, thank you so much. Alex Brazier, their deputy head at BlackRock Investment Institute, stays with us. We'll talk a lot more, of course, about maybe some of the fault lines and whether there's even a tool for central banks to deal with some of these issues. Coming up, Chinese stocks climb as Beijing eases COVID testing rules. We discuss that next with Alex, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Australia's central bank raised its key interest rate to 3.1%, the highest level since November 2012. Well, Bloomberg's Kriti Gupta has the very latest. Kriti, I mean, it's huge, actually, in terms of what we could infer from it for other central banks, but also differences.
Absolutely. I mean, this is such an important decision because the context is everything. We were going into the decision saying that might not even be a hike at all. We might actually see the RBA actually pause. The markets were even pricing in 19 basis points. Economists saying 25 basis points is the hike that we were going to get. And the economists actually won out. Nevertheless, the effect you're seeing in the markets right now, a stronger Aussie dollar, yields on the front end really soaring. And I think what's crucial about this particular takeaway is that the RBA has traditionally been this early mover when it comes to central bank policy and monetary policy. They were the first to tighten and tighten aggressively because of the commodity exposure. They may also be the first to completely pause altogether. Back in October, they were the first to make that pivot to a 25 basis point hike. The step down we're talking about for the FOMC, for even the Bank of Canada that I believe we're going to get later today during the U.S. session, that is all, of course, being forecasted, or I should say, led ahead by the RBA's decision months ago.
So, Kriti, very briefly, I mean, the parallels to other countries are there, but it's also different, as you say, very commodity rich, very exposed to China.
Very exposed to China, and this is where you're starting to see the divergence. This is crucial as we talk about the RBA dealing with a housing market that is already kind of collapsing at a time when other global housing markets, think Canada, think the United States, even think right here in the UK, haven't seen that same deceleration. On top of that, the commodity exposure to the EM complex makes it extra sensitive to those moves, something that you haven't yet seen for the Fed, by the way.
Okay, fabulous. Of course, a great insight into some of the housing worries. Also, globally, the RBA, they're looking at whether this is a kind of precedent or not for other central banks. Kriti Gupta there with the very latest. Now, let's get back to Alex Brazier of BlackRock. Alex, so look, we put the spotlight on the RBA and trying to figure out whether actually this also reads into what China does or does next. And you beautifully explained that actually what China needs in terms of the strength of the economy is domestic consumption. On the back of that, do you expect regulation, some of the consumption on luxury and things like that to be lifted, or will they still be the moral police whilst at the same time growing elsewhere?
Yeah, I think two things. One is they're clear that they no longer have just a single kind of sole-minded pursuit of growth.
Yeah.
They have other objectives, the Chinese authorities now. So policy response is more grudging than perhaps it was in the past, and that's one reason why we shouldn't expect the growth rates of old to be repeated in the future. The authorities will be more cautious. But I go back to this point that they will face big pressure now. And in fact, one of the reasons behind this COVID reopening, in addition to the social pressures, is the economic pressure that export growth is really coming off as a result of what's happening in the rest of the world. And as a result, China needs domestic spending to get going again in order to kind of fill the hole.
How do they do that? And again, and even if you look at the COVID policy, are you expecting it to be fully reopened by March, April, or are we going to see it stop and start like we have over the last 7 months?
Well, I think the policy in name will be loosened gradually over coming months, possibly quite quickly. But then the focus switches to, well, what actually matters in reality, which is the public health issue. And with relatively low elderly vaccination rates, limited ICU capacity compared to the West, that will place limits on how far the local authorities can actually reopen. And so we'll see a pretty bumpy path out of this, even though the policy in name is lifted.
Alex, we talk day in, day out, of course, about the UK, and I feel like the situation economically is just quite depressing. Surveys say, look, it's going to get worse from here. It's cost of living crisis. We're going into like a month of discontent with strikes. Do you see any, I don't know if it's reason for hope or a kind of glimmer on the UK assets?
I think they have repriced materially in some places, but the UK is a classic case in point of this issue that the central bank, if it wants to get inflation all the way down to its target, actually needs to generate a recession. And that's because the UK has the labour supply issues of the US and, by the way, Australia, and the energy supply issues of Europe, both thrown in together. So everybody else has one of those, the UK has both. And that means the trade-off faced by the Bank of England is perhaps even more acute than the trade-off faced by other central banks. It acknowledged that somewhat earlier than the others. But what it means is that rates are going up even as the economy enters a recession. And this goes to this point that we need to really think differently about central banks in this kind of supply-constrained environment.
So what lens do you look at it through? Are we definitely going to see a housing crisis? We saw, for example, mortgage rates coming off a touch. I mean, from 6 to 5.9, but is that a trend?
Yeah, I think the bank is trying to signal, and I subscribe to this view actually, that rates probably won't go as high as the market was pricing. And that's not because there won't be a recession, or the bank's trying to avoid a recession. That's because the energy shock and the rise in rates that's already baked in, and the effect that will have on the mortgage market, will already act to dampen demand very significantly. So, if you like, the additional work the bank needs to do on top of that is somewhat less. But I don't think, and the bank will try and avoid a mortgage crisis, as you put it. But nothing escapes the fact that the UK needs a recession if the bank wants to get inflation all the way back down to 2.
What kind of recession do you think we'll get in the UK?
Well, there are two possibilities. One is that we get a reasonably sized recession over the next 3 to 4 quarters. The other is that the bank manages to engineer a period, and this is consistent with its forecasts, I think, of reasonably weak growth, or 0 to slightly negative growth for a sustained period. You look at its forecast, it's talking about no growth in aggregate over a 2 to 3 year period. That's very serious, even if there are no outright output falls in that, and there probably will be. That's a very weak sustained period.
What has Brexit done to some of the economic prospects, and actually what can the government do to try and make up for that?
Well, perhaps start with what it can't do, which is, as we saw earlier in the summer, spend its way out of this, because increased fiscal stimulus doesn't change the underlying economics here. It doesn't change the fact that the bank needs a recession to get inflation down. It just means it needs to raise rates more to deliver the same recession. So what's really needed, not just in the UK, but in other economies too, is, and it's easy to say this, less easy to deliver, is supply-side reform. Things that boost labour supply, things that boost energy supply, things that boost productivity. But those things all take a long time to work through, a long time.
But so that's what, economically, if you just look at a spreadsheet, this is what, more immigration?
Potentially, although it depends. Governments have different trade-offs in that space. Australia is a good case in point, where the working age population growth has slowed hugely, just like it has in the US as well, as a result of an ageing population there. And that's something governments need to grapple with, is how to maintain labour supply in an environment where populations are ageing and natural participation rates in the labour force are falling. Do
you have any worries, and you were for 10 years at Bank of England in charge of financial stability, do you have any concerns, given all of these pressure points, that something could turn in the UK? Well, in terms of financial stability? I
think actually we had a good test run earlier in the year, and there were some difficulties. They've been smoothed through now. But I think as a result of that, I feel slightly more confident about the UK's ability to withstand some of this economic damage that's coming than perhaps I would have done 6 to 9 months ago.
I mean, could the UK actually be a crypto capital, or do we even want to be a crypto capital anymore, given what happened to FTX?
Well, I think on crypto, it's very important to distinguish the different aspects of this system. It's not some homogeneous lump. Things like properly stable, properly regulated stable coins, reasonable prospect. Things like tokenization of financial assets, really interesting prospect. But there's a lot of stuff around that that's very, very different. And so proper regulation to, if you like, separate some of these things that have real prospects from some of the other stuff, I think is very important in whatever jurisdiction, in making sure this can develop sustainably.
Alex, thanks so much. Alex Brazier, always on point, deputy head there at the BlackRock Investment Institute, joining us this morning. Now, coming up a little bit later in the program, as Ukraine fights for survival on the battlefield, we also focus on the beginning to turn Kyiv's finances and the cost of rebuilding the war-torn country. We actually speak to an official from the Ukrainian government. This is a Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned the US and EU are weighing new tariffs on Chinese steel and aluminium as part of a bid to fight carbon emissions. The move would mark a novel approach, as the US and EU would seek to use tariffs usually employed in trade disputes to further their climate agenda. The idea, which originated within President Joe Biden's administration, is still in the initial phase and hasn't been formally proposed. Now, South Africa's governing ANC says it will tell its lawmakers to reject an independent panel's report that President Cyril Ramaphosa may be guilty of violating the constitution. Lawyers for the president are preparing a court challenge against the report that said there may be grounds for his impeachment over the handling of allegedly stolen money. A spokesman says Ramaphosa will not quit and will seek a second term as the party leader. Now, the UK is said to be planning to announce measures this Friday aimed at boosting growth right here in the City of London. Sources tell Bloomberg the Treasury will sweep away unnecessary regulations on financial services in a bid to rescue new post-Brexit opportunities and boost competitiveness. Two policies floated so far are the repeal of the banker bonus cap and adjustments to the ring fencing regime. And former President Donald Trump plans to hold a telephone rally for the Republican candidate ahead of Georgia's Senate runoff election today, opting not to campaign in person. Polls indicate the result will be close between the two parties. The election will determine whether Democrats win a 51st seat in the Senate, making it easier to pass legislation. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, markets really struggling for direction today. Traders actually weighing on prospects for a slowdown in the pace of U.S. rate hikes. So let's have a look at the markets. If we have them to look at the boards, and of course, we want to put that against data that's showing, for example, that there's tighter policy that may be needed for longer. Now, if you look at what we heard in the U.S., resilient U.S. economy, but also sticky inflation, really countering some of the optimism about a reopening in China, money market futures, but also economists suggesting that the Fed will need to push rates to a higher peak than previously expected. Some of the other things we're watching, of course, apart from risk assets, is Beijing announcing it will scrap COVID testing requirements for most public venues. This really is seen as an accelerated move towards the exit of COVID zero policy. Coming up, a bleak winter. CBI warns that the UK has already fallen into a short and shallow recession that will leave business investment below pre-pandemic levels. We'll look at that next, and this is Bloomberg. Re-rating rate bets. Well, global stocks struggle for direction as surprisingly strong U.S. services data feel concerned that the Fed will need to tighten more than expected. Not done yet. The Reserve Bank of Australia raises its benchmark for an 8th consecutive month and warns there's more to come. The Aussie dollar climbs. Plus, the U.S. and EU are said to be weighing joint tariffs on Chinese steel and aluminium to fight emissions and global overcapacity. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So the CBI is warning that the UK economy faces a decade of lost growth unless the government takes action on investment tax relief, the Northern Ireland Protocol, and the shrinking workforce. Now, the business lobby group says the UK has already fallen into a recession that will leave business investments 9% below pre-pandemic levels. Now, we're joined exclusively by Rob Hornby. He's head of EMEA at Alex Partners. Alex Partners, of course, being a big turnaround company. Rob, thank you so much for joining us. I mean, there's so much going on in the UK. I feel like every day there's like a downbeat headline on the recession because of all the problems that other countries have, but really kind of put into one here. What does it mean in terms of the stress levels that companies in the UK will face?
I actually can't remember a time like this where long-term trends and short-term trends have kind of got companies in their jaws. And the job of chief executives in particular, but executives and boards, I think is pretty tough because they're having to fight tactically day by day and also not forget that there's long-term trends that could do them significant damage in the long term if they don't continue to invest.
So that means it's ugly. Is it an ugly picture? Like, how many companies could actually go under?
Of course, that's the million-dollar question, isn't it? But it's a strange situation, and I think it's unlike some previous recessions because all the cheap money that was out there was either covenant light or in some cases covenant free. So we're not going to see the classic triggers taking companies into restructuring. Of course, there might be some auditors who become worried about signing the going concern, especially with year ends and calendar year ends coinciding.
So you're expecting bankruptcies, Rob? When you
we will
look
see that.
UK
yes.
PLC, are there sectors that seem more vulnerable because they're over leveraged because they borrowed more and now can't cope with the pending recession?
That's definitely the case, but I think it's deeper than that because even healthy companies are facing extraordinary pressures. Anyone who's moving a widget, anyone who's got a customer who is a person struggling with the cost of living crisis, I think is under a degree of threat.
And this is after 2 years of pandemic. So is there anything that a lot of these companies can do now, or is it almost too late because we're now into the winter, energy prices are going up, supply chains are still a struggle, and everything's just getting so much more expensive?
It's never too late to take action. I think perhaps the most frightening thing would be just sitting there and hoping it will end, because the long-term trends are not going to end, and the short-term ones look a bit medium-term increasingly. So taking action, I think, is imperative. Companies need to fight every day, fight for supply chain, fight to retain their customers. but they also need to keep investing and keep thinking about the future.
Yeah, and that's pretty, I mean, that's pretty basic. As a chief executive, that's kind of what you want to do. But is there, and there's no quick fix, is there any government help that they can have? Like, if you dig a little deeper, is there a sector that you're particularly worried about just because of leverage finance? And again, it's not the same if you have interest rates at 1%, if they go to 4 or 5% in a short amount of time.
I think we have to be worried about all consumer-facing industries at the moment, because if we do have a recession, of course, we're technically in one now, that's likely to put enormous pressure on customer-facing businesses that have been under pressure in the pandemic. And then anyone who has a physical product is struggling, particularly if they have globalized supply chains.
So, Rob, are we talking about 15% of companies potentially going under? I know at the beginning of the summer, I think we saw some surveys saying, look, 1 in 5 are in danger. Like, what kind of figures are you looking at? Like, have you hired extra staff to deal with potential bankruptcies in the UK?
So we are expecting a very busy time. I think it will be a brave person who put a number on it, but we are expecting it to become progressively busy. I don't think it'll become dramatically busy.
I was going to ask, is there a crunch time? So once you get into the winter months, does it get easier? If you look at CBI, if you look at some other projections, crunch time could also be third quarter of 2023.
I think the end of the year is always a crunch because there are lots of fiscal year ends coming up. And I think that's a day of reckoning for some companies. But as we get into an extended period and the long-term stresses of the short-term pressures, I think we could see companies that have lasted and lasted and lasted finally just have nothing left.
So what does nothing less mean? Like actual having to close down, or is there a period of moratorium? Like how does it work after the furlough schemes and the 2 years of pandemic?
I think the simplest issue is that they run out of cash eventually. Of course, there's been a lot of cheap money, there's been a lot of government help, and that's kept companies who really shouldn't be functioning at this stage in a normal way, appearing to do just that. And that is going to run out. The question is when, and I think over the course of next year.
So, Rob, you're telling me two things, right? It's companies that maybe shouldn't have not survived this long, that have survived, that could go bust, but ones that are also healthy, that are also at risk of going bust. Like, how do you differentiate the two? So if you're an investor, if you're a private equity, if you want to go in, like, how do you tell the difference?
Healthy companies are probably not at risk of going bust in 2023, but the long-term trends were very disruptive already. Digital, demographic shifts, they haven't gone away. So I think we're going to find the long-term effects of those making companies that seem healthy today uncompetitive. And I think all the short-term pressures are going to accelerate and compound the long-term trends. And companies today that look great, I think we could see them struggle in the second half of next year. All
right, Rob, thank you so much. Rob Hornby, their head of EMEA at Alex Partners, joining us this morning on the UK. Now, coming up, as Ukraine fights for survival on the battlefield, focus is beginning to turn on Kyiv's finances and the cost of rebuilding the war-torn country. We speak to the Ukrainian government's Commissioner for Public Debt Management, Yuri Butsa. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's focus on Ukraine's economy. Its central bank governor has told Forbes it will likely cut its economic outlook following Russia's continuing attacks on the country's energy system. Meanwhile, further sovereign debt restructuring from Ukraine is also expected following the deal with bondholders to defer debt payments reached in summer, with the latest figures showing that the economy contracted 31% in the year to October. Now, we're joined by Yuri Butsa, Ukrainian Government Commissioner for Public Debt Management. Thank you so much, Mr. Butsa, for joining us on such an important topic. If we're going to rebuild Ukraine, it starts also with bond restructuring and, of course, some of the deferred, debt payments. Where do you see debt payments and the deference actually being resolved? What's the right way forward?
So it's an interesting question, because when we came with the proposal to the investors back in summer, so we had pretty much two things to keep in mind. The first one is that we need to preserve liquidity.
Yeah.
The second one, that is full uncertainty, and we don't know what will happen in 2 years from now. So that was the proposal from our side to postpone it for 2 years and see what happens. So at the moment of time, we still need liquidity and still have no visibility what will be 2024. So it's very hard to say that we have any precise idea at the moment of time, but we keep on being engaged with investors and keep on talking to them and see their view and see their expectations, because in any way, whatever we'll come up with, we view it as really as a previous transaction in coordination with investors and investor-friendly approach.
And this is this is extremely complicated, of course, because of the ongoing war in Ukraine. But under what conditions do you see a restructuring possible? And would the Ukrainian government insist on a haircut for investors?
It's very too early to say, because there are both positive and negative scenarios which can materialize. What we need to have as a prerequisite for any discussion is a sound macro framework for at least 3 years to see what will be the debt burden. So if you look at the total debt stock, it's not that big. In absolute terms, it's getting bigger comparing to GDP, because we're losing a big part of GDP due to the Russian attacks. So that's a big problem. And we need to have a bit of more certainty in terms of what will be GDP trajectory before making any decision.
So is that also true for, and we're trying to figure out, of course, as investors, to give the best opportunity for people that want to invest in Ukraine or that will invest in the future, is trying to understand the level of haircut that would be acceptable both for creditors but also for the government. Is there a range for that?
Look, we are not in that type of discussion. What we clearly understand is that we need to preserve the interests of investors, because there are no other investors to Ukraine. So the same investors we rely on money is the same as the current investors to our bonds. And that's why any solution we will discuss, it should be really accepted by the market in the first place.
There's a number of Ukrainian corporates buying back some of their debt. Is it an option for the government to do the same?
Look, from economic standpoint, is the most optimal solution, because the debt is traded at 20 cents to the dollar now, Ukrainian sovereign debt, and there are no restructurings. I remember in other countries being done which had bigger savings than that. But that's about economics, right? If you talk about the priorities, so obviously priorities of the government is to use our resources, which we collect, to fund the military expenditures, and use the donor resources to fund all the social and humanitarian expenditures. And that's so we are much more preoccupied now to find all these resources for the 2023 rather than think about payments and 2024. However, yes, we understand why corporates are doing that, because that's the way how to create a much more of long-term or mid-term savings in the current environment.
So when you look at the government financing, how much is domestic debt attractive compared to other international financing sources?
Look, domestic debt was a key source for funding for us when the war started, mostly because of the sympathy from domestic both financial institutions, but also the population. So we see now that there are a lot of support through the war bonds by Ukrainian population, and we make it as quick as interactive as possible to enter to that market for the private individuals. In terms of general government bond market, we see a bit of revival now. We see that we started this year when people were looking at very short-term instruments, mostly just to continue support. Yeah. Now there is genuine interest to something which is maturing second half of 2024. So we see the financial system starts to look how to lock themselves in the higher yields post the tightening cycle of the central bank, and that's really a good sign for us.
I mean, of course, we follow on Bloomberg, a lot of the trials and tribulations and, the incredible saddening images coming out of Ukraine. In the last 3 to 4 weeks, there's also been huge, enormous hits to infrastructure, energy from Russia. I think when you updated investors and the markets on your budget for 2023, that had not happened yet. So do you have to change the amount of money you need to rebuild some of those hit infrastructure projects?
Look, this calculation, unfortunately, increasing every week, and those numbers going up. So we're looking at a combination of sources, because most of the damages are done on the level of companies, and sometimes it's easier for us to ask the donors to provide the funding directly to the company, like Ukrenergo, for instance, who can get the funding from EBRD, because EBRD is, or EIB, for instance, and they help them already, and get the grants directly to the company, rather than to channel them through the budget, because it's more lengthy process and less efficient. But we help as a government in all possible ways for the companies to have this funding in place.
Do you have a number in mind? And it's terrible, really, putting numbers on also the loss of lives. But I know the IMF were saying some $3 billion a month I think, into next year?
In very immediate funding, we already committed, and the company is committed, is hundreds of millions of dollars already. So I wouldn't expect it to be below a couple of $1 billion in the total cost. So I would think that IMF numbers are really showing the approximate range. Unfortunately, as I said, those numbers are increasing the more Russia tries to hit the civil infrastructure in Ukraine.
If there's any of the money delayed, actually from the EU into Ukraine into next year, is there anything that could substitute that source of funding?
Look, we hope that this next year will be a bit different in that sense in terms of predictability. We really count on today's positive decision of Council of Ministers in EU, because if there are delays in disbursement, so the only alternative, because we cannot stop paying pensions and salaries, so the only alternative for us is monetary financing, and we don't want to rely on that source. So we hope that next year will be more predictable in terms of timing of disbursements.
All right, Yuri Butsa, thank you so much. Of course, we, first and foremost, think of the people of Ukraine and everyone who's losing their life, but also an important conversation on some of the public debt and financing. He is Government Commissioner for Public Debt Management in Ukraine. Thank you for joining us today. Now let's get straight to a Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Beijing is scrapping COVID test requirements to enter supermarkets and most public venues from today. The move marks a retreat from strict policies that at one point saw a testing booth on every corner in major cities. Negative 48-hour test results will still be required to enter bars, restaurants, and also schools. Taiwan's Honhai, also known as Foxconn, has reported sales for November down more than 11% from the previous year after shipments were affected by a COVID outbreak in central China. Last month's outbreak led to a worker exodus and violent protests at its factory in the city of Shenzhou. The plant is where the bulk of the world's iPhone Pro handsets are assembled. Now, Apple has been sued by two women who say its AirTag devices make it easy for stalkers to track their victims. The small tags, about 3 centimeters in diameter, are intended to be slipped into or attached to personal possessions, like your backpack or your keys, to help owners locate them. But privacy advocates have warned it can also be used to track people without consent. Apple, which advertised the AirTag as stalker-proof, didn't immediately respond to a request for comment. And PepsiCo is reported to be laying off hundreds of workers at various headquarters in North America. Dow Jones says the jobs will go into its beverage business based in New York and at its snacks and packaged food units in Illinois and Texas. PepsiCo employs around 130,000 people in the US and 300,000 around the world. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne Gerrans. Now, we're also getting some figures from IATA. The global airline industry, they say, is expected to report a $4.7 billion profit in 2023. Now, the chief economist also sees no major risk of global recession. That, frankly, is a surprise given some of the figures that we had, but maybe they're looking at travel demand to and from places that will not be affected as much as recessionary pressures we could see elsewhere. The chief, of course, of IATA also saying actually the worst for the moment is over. This is the International Air Transport Association predicting that the airline industry will book a profit next year. It's first since the start of COVID as travel rebound in the U.S. mainly, for example, makes up for the impact of continuing curbs in China. Now, stay with us for more on that report. We'll be speaking with the IATA Chief Executive, Willie Walsh, at 4 p.m. London time. That's 11 a.m. in New York. Now, coming up, Tesla shares fall on a plan to cut output of EVs at its Shanghai factory. We have the details next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Tesla shares took another leg lower yesterday on reports that the EV maker is planning to lower production at its Shanghai factory. It's the latest sign that demand in China is not meeting expectations. Now, joining us now is Craig Trudell, Bloomberg's global auto czar. Craig, also on Twitter Watch. I'm kidding. He does focus more on cars, but there's that little distraction of Elon Musk tweeting on Tesla. Like, what can you tell us about China? It's not, I mean, it's not doom and gloom, but also it's not looking great.
Yeah, it is. There's some real nuance to this story, right? Where we just yesterday got some really significant numbers in terms of deliveries for Tesla in China. This is not a company that's really hurting in that market, but it is a question of can they continue to grow the way they've been growing year after year? And increasingly, there are some sort of warning signals that in order to achieve that growth, they may need to, bring price down, and that's, going to alarm some analysts who, got used to this company not only growing at really impressive rates year after year, but doing so with really strong margins. And, is this a matter of, a low margin business, the auto industry, eventually catching up with this company that, has managed to post much bigger margins and growth, year after year.
So, Greg, what does this mean for? I mean, is this really all China demand? Is it actually the factor on how they operate, and how can you turn it around?
I think it's also a case of increasing capacity globally, right? So, we've had two factory openings this year, one in Germany and one in Texas, and so this idea that finding the sort of demand and production balance and getting to a point where, maybe production has caught up with demand, what does that do to the dynamics of Tesla and to those margins that everyone has gotten used to, being bigger, higher than other competitors? So.
Is it kind of like a warning shot for other EV makers, or is it specific to Tesla? Well,
interestingly, we've seen some price increases by some of Tesla's competitors, and I think that's another reason that there's a bit of cause for concern here. Principally BYD, I think, is the company that has most gotten attention for both the pace of their growth and the sort of competitive dynamics, the fact that they're moving some prices up. And also, moving up into the segments that Tesla competes in, higher price EVs. That's another reason to be a little bit concerned if you're, invested in Tesla.
So, Christmas time in London, a lot of dinner parties, and everyone's saying, like, what do you think of Elon Musk? And I'm like, I don't know. Let's ask Craig. I mean, the amount of tweeting he does. Is damaging him, or is it just kind of like a side job? I think it's definitely damaging Tesla, because he can say every now and then, and he has for every 20 tweets about Twitter, he sort of insists I still have my eye on the ball with Tesla, but it's sort of belied by the fact that those other 19 are all about Twitter, and I'm probably being generous there in terms of the volume of Twitter-related tweets that he's doing. So absolutely, it's a distraction, and it's sort of the realization of everyone's concern when he was interested in this company months ago, that this was going to be more than just a fad or a passing phase on his part. You're not a car editor at all. You're like a Twitter now, right? I'm new social media. Watch. There you go. Surprise. We'll find your new title. Craig, thank you so much, as always. Craig Trudell there, Bloomberg's global auto czar, with a side job of looking at Elon Musk on Twitter. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz in New York, and Edwards here in London. The focus firmly, of course, on some of the jobs on data that we had overall in the U.S. If we're seeing stronger growth, certainly for services, what does that mean for the Fed's terminal rate? That's coming up next, and this is Bloomberg.
The idea that there's going to be a major pause or pivot, I think, is pretty unrealistic.
It takes a lot to slow this freight train.
They will have to stay at this restrictive level for a period to come.
The Fed cannot really pause or cut. It has to continue, but is going on a track now of slower hikes and try to feel out where we get the right level of interest rates.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. European futures and Asian stocks have been heading lower. The latest economic data has investors betting that the Fed's terminal rate will be higher than expected. U.S. futures struggle a little for direction. A novel approach by the US and EU. They're considering new tariffs on Chinese steel and aluminum as part of their fight against carbon emissions. And voters in Georgia decide today what the United States Senate will look like for the next 2 years. They're going to the polls or in a runoff election. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And European equity markets then a little sluggish today. Kailey, US futures actually now turning that indecision into some slight gains. But we didn't need reminding over the last 24 hours that good data, good news on the economy can be bad for risk assets.
Yeah, especially if it means the Federal Reserve is ultimately going to have to go harder for longer and we end up at a higher terminal rate for an extended period of time. That is something that equity markets really around the world are contending with and why we saw such a mixed session in Asia overnight. You did have equities in China, for example, positive on the day. You are still getting those incremental updates on the relaxation of COVID restrictions and testing rules. So that lifted equities there. But overall, the MSCI Asia Pacific Index down about 1% as the Fed is really under consideration for a lot of Asian risk assets and Asian currencies as well, most of them weakening against the US dollar today, including the South Korean won, the big underperformer among Asian currencies, weaker against the dollar by more than 2%, heading for its worst day since March of 2020. Right now, dollar won trading at 13.19 at the moment. And the Aussie dollar, I would note, though, is gaining against the U.S. dollar by about 0.25%, trading right now at around 67 cents on the dollar after the RBA, as expected, hiked rates 25 basis points. What maybe was less expected is the fact that they said they are not done and that policy is not on a preset course. So perhaps a little bit more hawkish than anticipated, which is what is leading to that Aussie strength and leading yields higher in the Australian bond market. That 3-year yield up 7 basis points overnight to 3.086%, Matt.
All right, we're looking at a little bit of a turnaround for sentiment here, at least momentarily. We have S&P futures unchanged, and we had been gaining earlier this morning after the big drop that we saw in the cash trade yesterday. The S&P was down 1.8% yesterday. The NASDAQ off almost 2%. So it did look like we were going to have a rebound. Now, not so sure. You can see S&P futures unchanged at 4,005. The cash trade closed at 39.98. The dollar index, maybe one reason, gaining a little bit of steam, up about 0.1% at 1267. So not a lot of strength, but at least a green arrow there. We did see a turnaround as well in crude. At least I saw Brent up earlier in the session, and it is now unchanged. NYMEX crude is down about 1/3% at 76.67 a barrel. Finally, Bitcoin showing its, I guess, can I say trademark stability? Is that fair for the underlying asset? After the collapse of FTX, we dropped to 16,000. We've been holding there for over a month now. We have risen. Yesterday, we rose up over 17,000 briefly, and we're holding at around that level right now, Anna, $16,980. What do you see in terms of the European markets?
Yeah, well, we seem to be telling the story of the last 24 hours, Matt, which seems pretty clear. The story from here, less clear, as you just showed in US futures. They've been a little more positive than that earlier on, now fairly flat on the US futures picture. This is what European markets look like right now, but really playing catch up with Wall Street. So yesterday we saw that services data out of the United States weighing on sentiment because it was strong on the back of strong jobs data on Friday. And finally, the market plays catch up with its thinking around the terminal rate and what that means for Fed expectations. So that is all weighing on European stocks today. Not weighing on the utilities sector. I put that one in because it's one of the bright spots, up by 0.2% on utilities. Marston's is a pub business. So whilst the World Cup, the soccer, the football tournament that is currently taking place, of course, in Qatar, might not be good for trading volumes when it comes to equity markets, but it's certainly good for pub drinking volumes, and that seems to be the story coming out of Marston's, although the share price there was higher a moment ago. The natural gas price was up by 4% a little bit earlier on, now up by just 1%. This on the back of some of our reporting that suggests that the weather is going to get colder here in Europe over the next couple of weeks. Some of that long-range or medium-term forecast suggesting in the next couple of weeks we will get an Arctic blast, and only southern Europe will be spared from that, much of Europe going into freezing temperatures. South Africa, the 10-year yield in focus here. This is obviously to do with the political tension. We heard from Fitch, the ratings agency, Matt, just yesterday, saying that all of the drama surrounding Cyril Ramaphosa, his fight for political survival, that is adding to uncertainty around policy. And so we keep that in mind as we look at what's happening to debt globally, Matt.
All right, we'll keep all of that in mind as we look at investors right now loading up on bets that an economic recession could be avoided. At least that's according to a study from Goldman Sachs of assets totaling about $5 trillion. Bloomberg TV's Kriti Gupta joins us now with the details. So, Kriti, what's the argument for a soft landing here?
Well, the argument for a soft landing is pretty simple. If you are worried about the Federal Reserve essentially tanking the economy in order to fight inflation, well, the mantra is going to be sell everything. And that's kind of what you've seen with the carnage of 2022. But David Kostin over at Goldman Sachs is saying, well, actually, if you look underneath all of the bearish bets, you can actually see some outperformance from a lot of the cyclical names. Think industrials, think financials. A lot of the sectors that are supposed to outperform in a growth phase and an expansionary phase, those are the ones actually outperforming even as they're pricing a recession at the benchmark level. On a more sector basis or on an individual stock basis, you're not necessarily seeing that. Is that a function of people just being late to the game, of people closing out positions earlier before the year's actually ending, or is this an actual change in terms of the mindset of whether or not the confidence is actually in the Federal Reserve?
So, Kriti, it becomes a question of whether or not Kostin's take is the right one. How does that track with what we're hearing from other strategists and their expectations for next year?
Well, I think the way to look at it is just the most recent market move that you are actually seeing from the trough, I believe, going back to October 12th. Remember, we are dealing with an era for the stock market of essentially these bear market rallies, and whether or not one of them will turn into a more sustainable rally for the equity market. And so far, with every rally, you have actually seen exactly what David Kostin over at Goldman is actually talking about, the idea that it is led by those cyclical names. Once again, financials, capital goods, industrial equipment names, even semiconductors, which are now being kind of counted as more of a cyclical basis instead of defensive under the tech name. So by that standard, Kailey, David Kostin's right.
Kriti, thanks very much. Bloomberg's Kriti Gupta in London for us this week, but with the lowdown on the markets there and the Fed narrative. Now, in China, a COVID outbreak that began last month appears to be tailing off. Infections have fallen each of the last 8 days, but at the same time, there's been a pullback in the sweeping testing regime in major cities. Could those things be linked? Bloomberg guests weighed in on their outlook on China reopening.
China only grew 3% this year as against an expectation of 5%. So now the authorities are pressing forward on all gears to get to the 5% GDP number next year.
If China is going to continue to soften the COVID rules over time, fully reopening of the Chinese economy would be really risk-on.
The way to reopening is likely to be a lengthy and relatively bumpy one. And with market probably already getting slightly ahead of itself.
We're cautiously optimistic on reopening in China. It's going to be one of the big stories next year. We think there's probably significant upside to go, let's say 25 to 40%.
Rebecca Chung-Wilkins, Bloomberg Asia Government and Politics correspondent, joins us now from Hong Kong with more. I mean, there is a sense that perhaps if you test less, you find fewer cases, Rebecca, but the reopening enthusiasm continues and as we continue to watch, perhaps with some worry, rising COVID rates in recent days.
Absolutely. And it is worth saying that testing overall is still actually relatively high when you think about the sort of nationwide push and fervor with which they test. The general sense is that they have a very accurate sense of numbers because of this widespread testing. Of course, when we see a pullback, potentially that could influence the falling cases, although the pullback is relatively new. So we're seeing it first in sort of Beijing and other major cities, Shanghai, Hangzhou, and so on, where essentially you no longer need a negative test to enter quite a variety of public venues. I think that the feeling is that that is going to continue to be rolled out across China, and possibly the infection rates overall have now crested from that November peak that we saw, somewhere around 39,000 cases a day.
So what do you see in terms of emergency room occupation there? What do you see in terms of deaths?
Well, that's certainly the big concern, to what extent we see this quote-unquote disorderly exit from COVID. Now, I think that Becky Liu's comments from Stanshot are probably the most apposite here. It's going to be a lengthy and a bumpy road. The real concern is that in China, access to healthcare is, of course, incredibly divergent. So if we look at, for example, Beijing's capacity to cope, it has the best healthcare system of any city in China. they obviously will have a much better ability to deal with rising cases. And in Beijing, for example, we are seeing low-risk patients being allowed to stay in quarantine at home. Now, that's going to be very, very different if you look at sort of, for example, some of the poorer areas and also some of the more rural areas of China where there won't be the same access to care. The other element of this is also persuading people who have been so frightened about catching COVID that it is sort of safe to, quote unquote, re-emerge in a way. And we are seeing, again, state media narratives sort of playing up this idea that local governments are taking really sort of extreme steps to keep people safe, as well as giving us guidance on how to actually avoid catching COVID.
All right, Bloomberg's Rebecca Chung-Wilkins, thank you so much. Meanwhile, Bloomberg has learned that the U.S. and EU are considering new tariffs on Chinese steel and aluminum. Talks between the U.S. and EU to jointly address the climate crisis are a positive sign after Biden's signature climate law has been criticized by European leaders for discriminating against the EU. So, Anna, this is definitely an interesting one, especially on the tails of the meeting between President of France, Emmanuel Macron, and President Biden at the White House last week, where some of the U.S.'s policies around EV credits, for example, here in the U.S., were a point of contention.
Yeah, absolutely. So there did seem to be this transatlantic tension around the Inflation Reduction Act and the way it was going to support U.S. business, and in the views of Europe weigh on European business. And we're just seeing President Emmanuel Macron actually arriving at a conference that is taking place in Albania, in Tirana in Albania. He's arriving at that summit and giving his comments ahead of that. But back to the trade story then, Matt. Interesting to see that this policy around, trade policy is being used to try and influence climate policy in China.
Yeah, I think it's really fascinating because previously we slapped tariffs, we meaning the U.S. and the EU, on China for trade reasons, and now we're at least using the excuse of saving the world for doing the same job, Kailey. So it'll be interesting to see how China responds to those tariffs. Maybe they'll slap some counter tariffs on us to save the world as well.
Could we be talking about another trade war of some sort? All right, let's get back to the equity markets and talk less about geopolitics. Take a look at some stocks moving in pre-market trading here in the U.S. One of the biggest ones being GitLab. It is actually surging about 18%. It's a software company. Not only did it beat on revenue estimates in the third quarter, its forecast also topped expectations. Analysts noting that the company is proving pretty resilient even as IT spending budgets are getting cut back. So that is lifting the stock nicely this morning. It is also a move higher for another stock. And this one's an interesting one because there's not necessarily any real news, but Lucid Group, the EV maker, actually fell to a record low yesterday, bringing its losses for the year to about 75%. This morning, though, up about 1.6%. So maybe it's just a lot of people buying the dip. And one more stock moving to the upside is GE. This is off the back of analyst action. An analyst over at Oppenheimer upgrading the stock with a $104 price target, talking specifically about the strength in its aviation business. GE right now trading below that price target by a significant degree, right around $85.90 a share, up about 1.5% before the bell, Anna.
Okay, coming up on the program then, Kailey, we'll get to the macro stories with Holger Schmieding, Berenberg's chief economist, joins us. What are his expectations for European growth and for global growth as we head into 2023? And voters head to the polls for the Georgia Senate race. We are live in Atlanta. We'll get the perspective on the ground and the broader implications for policymaking stateside. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller here in New York with Kailey Leinz, Anna Edwards with us out of London. Now, if you're tracking the S&P this year, you'll note that we're in a bear market, but we've seen 3 or 4 little rallies here that continue to be brought down by good data, which makes the Fed, or makes at least the markets price in, a higher terminal rate for the Fed. The terminal rate continues to hit higher peaks as priced by the market. Right now we're at 5.22. Joining us now is Ksenia Galuchko, Bloomberg Equities team leader, to talk about how good news is bad news. Ksenia, on Friday it was the jobs number. Yesterday it was services, the ISM services figure that was just better than expected, and that leads markets to price in a higher terminal rate for the Fed.
That's right, Matt. But we also have to keep in mind that the rally that we've seen in the S&P 500 has been quite tremendous. It's been 17% from the bottom until the peak. So that has been a very, very formidable rally. And it's just natural that some players would want to take profit on that, especially as we enter the holiday season. And not many fund managers will want to be caught in the volatility in December, especially as U.S. inflation data, the Fed rate decision next week, Bank of England, ECB are coming up. So next week is going to be a very significant week where we might see much more equity volatility.
Yeah, that'll be interesting. Ksenia, good morning. But how much, given the strength of the rally that we saw, how much conviction was there behind that? Because I know that Citi strategists have been talking about this, saying there was only limited investor conviction behind the recent rally, as evidenced by some of the positioning flows that they look at.
That's right. So Citi is looking at the data from last week, and they're saying that despite the rally that we saw that was before the data on Friday, the positioning was actually quite low. So the conviction in the rally was not that strong. So they're saying that most players actually maybe already took a step back, and they're pausing and trying to see what the next data will bring. Again, the rally has been so strong. The S&P 500 moved above the 200-day moving average, which is a key tactical point. And of course, right there, you need to sometimes take a pause and see what the market will bring next.
Yeah, that tracks with Mike Wilson's view, who he took a look at that exceeding of the 200-day moving average and said, okay, we're sellers now. We're done with this rally. Ksenia, obviously, we're all looking ahead to next week and the Fed decision and CPI. Can we just declare the year over at that point, once that's over?
Yes, pretty much. I mean, all eyes are on that. But at the same time, just like I said, investors will not want to take bold bets in December. It's mainly CTAs and hedge funds that will be playing the market at a more intense pace. Generally, more institutional and mutual fund investors will already have closed most of their positions. They will want to cap this November rally, which was so extremely strong. It was one of the best months of this year. And they will want to go into the year end of the year with less volatility and not taking these bold decisions at this point.
Ksenia, thank you very much. Bloomberg's Ksenia Gilichko with the latest on markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. That's where you find the market's live blog. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. European stocks head lower. The latest economic data has investors betting that the Fed's terminal rate will be higher than expected. US futures struggle for direction. A novel approach by the US and EU. They're considering new tariffs on Chinese steel and aluminum as part of their fight against carbon emissions. And voters in Georgia decide today what the United States Senate will look like for the next 2 years. They're going to the polls in a runoff election. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, a little bit of US politics to talk about later in the program to distract us. But in terms of the market performance, the Fed front and center, and US equity markets, as we said in our headlines, struggle for direction a little this morning.
Yeah, absolutely. I mean, we saw markets, U.S. futures gaining earlier this morning after the big drops yesterday in the cash trade. They have now turned around and are falling. We're looking at S&P futures down about 0.2% now. Remember, the market closed yesterday down 1.8% on the S&P and almost 2% on the NASDAQ. So we had a big sell-off after that positive ISM services number. Maybe a lot of market participants think that all this good economic data coming out is going to be more ammunition for the Fed to raise rates further. And so now the markets are pricing in a terminal rate of about 5.25%. The Bloomberg U.S. dollar index gaining, but not much. You can see, actually, I should say unchanged right now. It's up only 3/100ths of 1% at 1267. Still far off the level of, I think, 1353 or something that we saw at its high. And investors and strategists that we talk to think there's more room for the dollar to drop. Right now, it's not doing that. If the dollar rises, of course, that's a headwind for risk assets. If it falls, that's a bit of a tailwind. NYMEX crude is coming down. We did see crude oil this morning earlier in the session rising as well. It has now turned around. NYMEX is off 1.5% to 75.82 a barrel. I believe Brent was up earlier and has turned around as well. And then Bitcoin still holding at 17,000. It had been for most of November at 16,000 after the collapse of FTX, but it's climbed up in recent days to about the $17,000 mark, and it's holding steady at that level. Kailey, what do you see in terms of the pre-market movers?
Well, there's not that much in terms of pre-market movers, which kind of speaks to the quietness and indecision we are seeing in the U.S. equity market this morning. The one real exception is GitLab, which is higher by about 18% in pre-market after reporting results after the bell yesterday. Beat and raise quarter. The outlook coming in ahead of expectations. Analysts really positive on the execution and resilience of this company, even in the face of an IT spending slowdown. So that giving a nice lift to that stock. But for others, we are seeing them come off of the pre-market highs, but the highs even weren't that high. The likes of Apple and Amazon were up about 0.5%. Now they're only up about 0.1%. And Tesla, one to keep an eye on as well. Remember, this stock fell more than 6% yesterday, Anna, after that Bloomberg scoop that they are looking to cut production at the Shanghai factory from as much as 20% from full capacity because of the demand issues in China. So that may be still creating a bit of a wishy-washy drag on the stock because Tesla right now is very little changed in pre-market.
Yeah, little change. Just adding that China story to the to-do list of the CEO, who is a busy man, as we know these days. This is what we see on European stocks then, Kailey. We're down by 0.6% on the Stocks Europe 600. Nearly all sectors actually in negative territory. So it's quite broad-based, this selling that we're seeing. And it does reflect yesterday's story around the Fed, but we'll see whether that has further legs into the US session later. Changing expectations, a revisit of the expectations around the Fed and the terminal rate based on that stronger data out of the US. The utilities sector is one that wasn't doing too badly earlier on. It outperforms, but not by much. Natural gas prices in focus, 134 euros per megawatt hour. And this is all to do with the weather. We've just been looking at some of the most recent data, forecasts around the weather for the next couple of weeks, and which suggests that an Arctic blast is on its way to Europe. And we know that that could make life difficult for people who are trying to afford those energy bills and indeed for businesses trying to afford those energy bills. We'll also keep an eye on the South African 10-year yield. We heard from Fitch yesterday saying that all of the political turmoil, Matt, that we're seeing in South Africa as the president there is fighting for his political survival. All of that is adding up to the uncertainty around policy making in South Africa.
All right, interesting story to say the least. We'll continue to follow that. Let's get back, though, to the markets and the economy. Joining us now is Holger Schmieding, Berenberg chief economist. And Holger, it's interesting. We continue to see strong news in the labor market for the U.S. In terms of the ISM Services Index yesterday, a big beat. And that drives market participants to calculate a higher terminal rate for the Fed. What are you expecting from the world's most important central bank?
Well, first of all, we expect them to slow down the pace of rate hikes. That is 50 basis points in December. And then we'll see early next year how the data shape up. We currently look for a terminal rate of 5%, but it is, of course, possible that it could be slightly higher. All in all, I would say the recent news flow has not been really negative. On the one hand, we have inflation where we had a positive, somewhat lower than expected print with some special factors. Now we see for the US hard data that the economy and survey data is holding up a bit better than expected. All in all, I would say that is not a negative combination.
Okay, Holger, good morning to you. Did you see any cracks? And I don't want to be the one who's looking for the bad news in the good data, but I know that many policymakers are, because there's a focus on just whether the Fed can weaken the labour market a little bit. Are you seeing any cracks in the labour market story? Because some guests point to some areas of the data that look a little bit weaker.
It's absolutely right. The major point about the US labor market is that at the moment we are getting quite a lot of conflicting data between the household survey and the establishment survey. And you can point to this or that and say, oh, this is still a very strong labor market, or at least a strong labor market. And you can say, oh, look, it's weakening. I would say we should take roughly an average of the data flow, including the job openings. And what it does suggest is that the US labor market is softening, but softening only gradually. And we'll have to see early next year, probably in February, whether that softening that we are seeing is pronounced enough to dampen concerns at the Fed about wage inflation, and hence for the Fed to call it that's it for now at 5%, or whether they want to go a little higher. Still, going a little higher if the economy is holding up a bit better than expected should also not be such a great negative.
Holger, back into the European story, if I could, for a moment. We're currently dealing, of course, with high inflation levels, and that's the battle, and fears about a recession in Europe, and perhaps we're already there. But looking back to the pandemic, we're still dealing also with the legacy of plans that were put in place around the pandemic. A German constitutional court today giving its backing to the next generation EU pandemic funding, which some call joint debt raising around the EU. Others say, no, it isn't quite. And you grimace at that description. How significant is it that the German court has come to this conclusion? What does it matter for Europe?
First of all, it of course is joint debt issuance. The second is the German court today let it pass, which is a big risk that has been avoided. In that sense, it's not really news. Few people expected the court to really stop this program. But the court also let it pass only with a lot of sort of reservations. It was not a clear bill of health for this joint issuance, which means the question whether after this temporary, somewhat limited and somewhat targeted program, there could be other joint EU programs financed by joint debt. That, from the German point of view, remains a very open question. It's still highly questionable.
Okay, difficult to say. Kailey?
Holger, while we're talking about Europe and the comparison with the U.S., 2022 has been a year in which central banks, including the ECB and the Federal Reserve, are all moving in tandem. How much could we see that diverge in the year ahead?
Well, upon the start of the year, we'll probably still see the Fed and the ECB and other central banks hiking rates to, say, 3% for the main refi at the ECB, 5% or slightly above for the Fed. But then over the course of the year, the picture could change. The European recession is very different. It's a response to sky-high energy prices. It's a response to anxiety about the winter. Once we've made it through the winter without Russian gas, or with very little Russian gas, once we've made it through, I think that in Europe the economic outlook will improve significantly, and we are hoping for a V-shaped rebound of the economy after a winter recession. In the US, the economy is slowing down gradually, and maybe in a mild recession, say by spring next year. In response to the US mild recession, the Fed may then cut, and probably will cut, interest rates from possibly September next year onwards, whereas the ECB, with the economy by that time in the V-shaped rebound from the recession, probably staying on hold. So we expect the gap between Fed rates and ECB rates to narrow late next year and in 2024, which of course would also support the euro.
Interesting. So you think the Fed is going to pivot back in the easing direction first. How much could China throw a wrench in that entire thesis you just outlined, Holger?
Probably not much. Of course, if something very dramatic were to happen in China, it would matter. But the balance between a slow, very slow easing of COVID restrictions, a bit more of stimulus, probably means that China has a rocky, wobbly winter. But this winter, we're going to have the European recession anyway. But then probably with more vaccination in China, with a further easing of COVID restrictions once the winter is over and the weather gets better, I would expect the Chinese economy to return to something approaching normal. And normal means around 4% growth from spring next year onwards. And in that sense, China will probably neither be a big help nor a big hindrance to global economic performance. No big hindrance, because by that time we should have sorted out most of the legacy supply chain issues.
What do you make of the trade slowdown that we're tracking, Holger? It seems like as we approach Christmas, we really should see a pickup in shipping. We really should see a pickup in cross-border trade, but it isn't happening even as we come out of this pandemic and prepare for a holiday season. Why is that?
Well, seasonal factors, of course, suggest there should be or should have been a pickup in the run-up to Thanksgiving and the Christmas holiday. But as we speak, the European economy has probably descended into a bit of a recession, the winter recession, the Putin recession, and that likely offsets the other factor on trade. So I wouldn't expect global trade to do well over the next few months. There is more likely to be some bad news on global trade, especially early next year, before over the course of next year, from spring or at least by summer onwards, it should then get finally better.
Okay, after we've got through the cold weather, Holger, thank you very much. Holger Schmieding joining us there from Berenberg. Coming up later today, an exclusive interview with the Goldman Sachs CEO, David Solomon, live from their financial services conference. We've seen reports this morning from other media around crypto aspirations, so we'll certainly get that into the conversation. 8 a.m. in New York, 1 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Port of Los Angeles Executive Director Gene Soroka. That's at 7:30 a.m. Eastern, 12 p.m. in London.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now, $65 trillion. That is the size of the off-balance sheet debt pile that the Bank of International Settlements, the BIS, is warning about, calling it a blind spot in global finance. Let's get the details from Bloomberg's markets editor, Valerie Teitel, who joins us now on set here in London. Valerie, good morning to you. So explain this to us. Why does this off-balance sheet debt pile exist?
Yeah, so this off-balance sheet debt pile, it's specifically focused in pockets of the market, what we call non-financial institutions. Those are things like pension funds, life insurers, for example, what we call non-banks. And they use currency swaps and FX forwards and able to hedge their portfolios and fund their positions. And there are also things like international corporations who raise money in dollars. They need to hedge that back into local currencies. They also use these things like FX swaps. All of this is treated off balance sheet, which means there really is no regulatory oversight in it.
Yeah, that sounds dangerous. So what do regulators like the Fed do about it?
Yeah, so the issue is that the size of this off-balance sheet debt is quite large. This piece from the Bank of International Settlement puts it at $65 trillion.
That number sounds almost made up, Valerie. I mean, what can total $65 trillion?
Yeah, that's 2.5 times the total U.S. Treasury market, Matt. But not only that, the scope of it, nearly half of it is outside the U.S. And then the maturities. They note that the FX swaps, of the maturities in the FX swaps, 70% mature in 1 week, 30% mature overnight, which means when there's a big run on dollar liquidity, you have these corporations, these non-bank entities really grasping for dollars. And it comes down to such short maturity assets that they're trying to roll over.
So, Valerie, what are potential solutions? Did the paper put anything forward?
You know, it really didn't. It's trying to push the conversation forward. I think what happened in the UK with the UK's pension situation, the blow up there, that the Bank of England had to step in and help, really put an eye on this. And I think the Bank of International Settlements really wants to have a broader discussion with other central banks on how can we further identify these pockets of weakness. They put it down to they really want to know where the geographies are. And to me, that says they want to know what currencies people are borrowing dollars against to know where there's weaknesses are. You know, we can look back in the 90s, the Asian financial crisis was really ignited by the fact that there was a lot of dollar-denominated debt backed by Asian currencies. And when those currencies started to weaken, they had a very large problem rolling over their debt.
Absolutely. And every time we think about the strength of the dollar, we wonder where the vulnerabilities to that lie, in particular in cross-border debt. Valerie, thank you very much. Bloomberg's Valerie Teitel with the latest on that potential headache for regulators if they can get their heads around the size of the problem. Now, coming up on the programme, we'll talk US politics. Voters head to the polls again today in Georgia to decide the fate of the US Senate. We're live from Atlanta next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's take a quick look at what is coming up on this Tuesday. EU finance ministers are continuing their meeting in Brussels. Plus, EU and Western Balkans leaders are meeting in Albania for an EU summit on the bloc's expansion plans. Here in the U.S., we'll get some economic data, trade data crossing at 8:30 a.m. Eastern. And finally, in politics, voters are heading to the polls in Georgia for the Senate runoff between Democrat incumbent Raphael Warnock and Republican candidate Herschel Walker. The polls open at 7 a.m. Eastern, so just about an hour from now. Joining us with more on what to expect from the runoff election is Christian Hall. He is Bloomberg politics reporter, joining us early morning from Atlanta. And Zach Cohen, our Bloomberg Government Congress reporter, is up early for us in D.C. So, Christian, if we could just start with you, obviously in-person voting taking place today beginning in an hour, but I understand there has been a lot of early voting. What does the latest polling indicate about how tight this race is and ultimately which way it's going to go?
It's a really close race.
But the signs of early voting, high levels of early voting, show that this is a really exciting race. There's a lot on the line here. 2021 and 2022, this runoff election is very different than past Georgia runoff elections. It's a big day.
So, Zach, tell us why this matters. You know, from the Democrats' perspective, they already, with a 50-50 tie and the vice president's vote, control the Senate. Why does 51 make a big difference?
You're right. Unlike the January 5th runoff in 2021 that decided the fate of the Senate in Georgia, being no stranger to these runoff elections, this particular one actually isn't going to determine control of the Senate. What it does do is sort of give Democrats potentially a little bit of wiggle room. If Senator Raphael Warnock is reelected, they would have 51 seats as opposed to the 50-seat majority that they have now. That gives them majority on committees. That gives them a little more leeway on procedural votes. If they lose a vote on a nominee, then that nominee can still get through. Democrats are very aware of the tenuous nature of a narrow majority in the Senate, as you've seen over the last 2 years. And certainly a Warnock victory would give them a little more flexibility, whereas a Walker victory, if the Republicans end up flipping the seat, the Senate would stay tied 50-50 because Democrats picked up the Pennsylvania Senate seat with the election of John Fetterman.
So 51 is very different from 50, as you described there, Zach. Christian, in terms of what is deciding this particular race, is it the same national themes that we were talking about last month, or is there a sort of local dimension to this we need to be aware of?
Well, I think, national issues like the economy are still, front of mind for voters. But this one is a little bit different as well locally. I think some of the scandals from Herschel Walker's campaign will be top of mind for voters. I also think that the Trump factor is a part of this decision for voters. Trump has been seen distancing himself a little bit from Herschel Walker in this race. So there are a lot of factors that are going to be impacting voter turnout today.
And on the subject of that turnout, Christian, what will you be watching in terms of demographics that could be a tell potentially on 2024 as well?
Yes, absolutely. Herschel Walker and Raphael Warnock are running today. I think Warnock is really going to be trying to turn out his base, turn out Black voters. Georgia has traditionally been a Republican bastion, but due to demographic changes and population growth, we've seen Black voters becoming a very powerful voting bloc in the state of Georgia. So I think that this can be somewhat of a projection of what can happen in 2024 in the state.
Zach, how soon are we gonna know who's got the edge? Are there gonna be exit polls here we can turn to? Will there be a live blog we can follow? Where do we get the info?
Well, certainly if it's a really close race, it's unlikely that we would get a result tonight. As we've seen in some of these other really close races in places like Nevada and Arizona, it took days to count the votes. Georgia counts its votes a little bit more quickly, even in the 2021 runoff between Raphael Warnock and the former Republican Senator Kelly Loeffler. There were results within a day, January 6, 2021, a day obviously that folks will remember for very different reasons. So we could have results sometime overnight, maybe early the next morning. It really does depend on the margin. If one candidate wins by a very large margin, then certainly we'll know the result much quicker. If it's a really close race, as Christian and I expect, it could take a little longer to count all those votes before people really know who the ultimate victor is.
And Christian, you mentioned the Trump factor. Clearly, his role in the elections that we saw last month, much scrutinized. I wonder if he's playing a similar role in this particular runoff, or if his tactics have changed a little, given what he learned last time around and what he plans for 2024.
Well, I think he's learned a little bit recently that his role could possibly negatively impact this race. Yesterday, he hosted a telephone rally for Walker rather than having an in-person event, kind of getting away from the campaign too closely. I think a lot of GOP strategists that I've spoken to have said that he's been urged by the party within to not get too close to this race.
Okay, thanks to both of you. Really good to get your perspectives on the programme. Bloomberg's Christian Hall in Atlanta with the mood on the ground and what's at stake there. Zach Cohen in DC with what more broadly is at stake, of course. That is it for Early Edition. Surveillance is ahead. Tom, John and Lisa will be with you. We'll be hearing from David Solomon, Goldman Sachs chairman and CEO. No doubt has a lot of interesting things to say as we head into 2023 about capital markets, about the economy and the Fed. This is Bloomberg.